Well, for a few brief minutes, the low of the day got protected, but now we are back below that 17,800 odd mark. So it's looking a little bit sketchy. Just to alert our viewers, though, buying around the 17,750 to around 17,770. That's what's been beneficial from a bullish perspective for the last few sessions. So it's very, very essential that the 17,750 holds out from the bullish point of view. For the time being, let's get our next corporate, Galaxy Surfactants. Well, they are the next corporate on our radar. The stock is near a 52-week low, according to Nirmal Bang Chemical Preview. The company is facing demand challenges in America, Middle East, as well as Turkey, as well as the rest of the world. Well, ICICI Securities, in its chemical preview for Q3, believes that the company's India business should see a steady volume performance. To discuss this, what's the outlook from here on? Well, we're joined by Mr. U. Shekhar, the founder, promoter, as well as the managing director. Hi, Mr. Shekhar. Good morning. Thanks so much for joining in. Well, things are looking a little bit sketchy, and you have mentioned in the past as well, the export market is looking a little bit weak. Tell us, how are things looking as of now? Have things recovered? Are you seeing some bit of a recovery? And more importantly, the FMCG companies that have already delivered their operational updates, they as well sounded a little bit cautious. Domestic demand is okay for you?
Yeah. So, India continues to be very robust. Demand is certainly coming back in US and parts of Asia. However, Middle East is a challenge exacerbated by the steep depreciation of the Egyptian currency by almost 100% since March last year, I'm saying. Again, you have had steep depreciation of the Turkish lira. So demand is a challenge and sluggish in the Middle Eastern region. However, India is a very, very robust story and demand is coming back with respect to United States. Europe is still weak. But all in all, I would say that this particular quarter and the last quarter, they should be a reflection of the second quarter of last year or this year. I'm sorry.
Sure. Mr. Shekhar, good morning. So when you say demand continues to be a challenge in the Middle East region, right? How much worse could it get? Because in the quarter gone by, your Middle East and Turkey region declined by almost 17%. Do you think this kind of a double-digit fall is something that you may have to reckon with in the second half of the year as well?
We would not like to hope so. The inflation is still very, very high in this region, triggered by the steep depreciation by almost 100% since March this year of the Egyptian pound. So, and then again, liquidity is very, very tight in these regions. Dollar availability is very, very tight. So what started about a year and a half, we would expect it to last even possibly another 6 quarters. Again, as far as this currency depreciation is concerned, the major currency depreciation has again happened in the last about month and a half. So this volatility puts a significant amount of challenge in terms of consumption at the consumer level. Now, though, as far as the FMCG goods are concerned, you can't do away with not using these goods on a day-to-day basis. However, consumers are downtrading significantly. So that's the situation. That's the reality.
Okay, all right. Mr. Shekhar, on the volumes front, earlier you were guiding for around 6 to 7%. That got scaled down for FY23. For FY23, what kind of a volume number are you looking at now? Getting away with flattish will be good. I mean, I want to understand yours. And I think for FY24, still you're talking about mid-high single-digit growth, right?
You said it right. I think as far as FY23 is concerned, we would be happy to, maintain last year's volumes. However, as far as the next year is concerned, FY24, we would aspire and aim for our 6 to 8% volume growth rate.
Okay. 6 to 8% volume growth rate. Got that. You spoke about how consumer downtrading has gone up significantly. This is quite concerning, is it not? And what would the pressure be on your operational performance? I mean, are you looking at more pressure on margins? You have seen a fair bit of it. I mean, you're still holding on to 10%, but you've done much better in the past. So what would the implications be of downtrading?
No, when I talked about downtrading, that is only with respect to the Middle Eastern markets. That's
Okay.
Egypt and Turkey, not the other markets. The other markets are doing, pretty well. The trend is continuing. If you look at India, premiumization continues. The e-commerce players are doing pretty well and scaling up further and further. Same is the case with US. The lot of e-commerce brands have started emerging and doing well. What I talked about downtrading is only with respect to the Middle Eastern markets, where the global companies are facing a challenge against the local players.
Okay, all right. Mr. Shekhar, what about, raw material supply? Supply issues have
Raw
got
material
sorted
supply,
out?
the raw material
Have they
commodity
got
prices,
sorted out? Mr. Shekhar, I want to ask you, they have got sorted out, is it?
they have got sorted out very well. I think the logistics rates are coming down. Logistics situation has improved significantly. The commodity rates have come down. So raw material situation is pretty good.
So then that could be in that margins will improve. Is that correct? If you can go by the margin, the volume flattish this year. Let's talk about FY24 since we are in a bit of a silent period. So for FY24, if you get that 6 to 8% growth on volumes and if supply side issues as well as freight is going down, then what kind of an EBITDA per unit can you do?
Yeah, we would always aspire to have our EBITDA growth higher than the volume. That's been the way we calibrate our business, and we would expect the EBITDA growth to be higher than the volume growth.
Mr. Shekhar, hi. Good morning. Just one question from me. For investors who sort of are holding on to your stock, I mean, they say, not all, but it's that business managers are also some of the best investors. So I just wanted to, from the highs of June last year, the stock has given up almost a third of its market value. I mean, actually about 35% since then. When will you kind of ring the all clear that things are looking a little better, or you still see that some time away?
I'm sure you have seen our first half results, right? The first half results compared to the first half of last year, the growth has been almost more than 50%, right? Now, as far as the market behavior is concerned, one needs to ask only the market. But whereas our performance certainly has been significantly better compared to for the same period compared to the last year. Yeah.
Sorry.
Yeah.
Okay.
Yeah.
So fair enough. All right. I don't think I can add to that or want to add to that. Thank you very much, sir. Appreciate you joining in.
Thank you. Thank you very much.
As you said, 23 perhaps is going to be a bit of a softish year in terms of volume growth, but it should pick up 6 to 8% is what you said it'll be in F524. Thank you very much. So there is the management of Galaxy. 17,790 is where we are at on the Nifty. We're down about 70 odd points. Well, let's turn our focus to the earnings corner. This is our special segment, Quarter Se Quarter Tak. We are tracking the oil and gas space. Q3 is expected to see a sequential improvement for most of the companies, barring a few. Prabal Sen is energy analyst at ICICI Securities, and he's joining us now to take some questions. Prabal, hi, good morning. Good to have you with us here. I want to start straight off the bat with, what your expectations are on Reliance. I mean, I guess the single most important name in that space, or actually for the market as well. It's looking quite weakish, at least on the screen. But in terms of earnings and numbers, what are your expectations?
I think for Reliance, one thing that stands out is that the OTC segment is expected to perform slightly better on a QOQ level. We expect that the OTC segment will definitely improve with the aid of higher refining margins, albeit the petrochemical segment does remain weak, and there was maintenance shutdown on the refining segment as well. But on the overall basis, given the lows that were hit in the second quarter, at least sequentially, we expect that the EBITDA from at least from the OTC segment should definitely be higher, and that is what propels the 11% YY improvement in overall consolidated EBITDA that we are penciling in, which translates to about 5% sequential growth. Geo continues to sort of show steady growth. Retail continues to grow well. Upstream, of course, is doing better than what it was a few years ago. But of course, I think the next round of real growth will come when the remaining parts of the new fields start the production, which is expected by the latter half of FY24. But till then, I think from where we were rather in Q2, Q3 would definitely look better, and Q4 can probably show better growth on top of that as well, based on what we see on the margins front, as well as prospects for geo and retail. So overall, we expect about sorry.
Sure, got that. So you're saying that overall Reliance can show better growth in Q4, both in terms of geo, retail, and you spoke about the oil and gas business as well. I wanted to move on and talk a little bit about the city gas distribution companies, because over there Q3 saw record high domestic gas prices. Now this was passed on to some extent, but what do you think the damage would be to the operational performance for names like MGL, IGL and Gujarat Gas?
Well, I think surprisingly enough, the kind of pass-throughs that have happened of the increase in domestic costs, plus the fact that spot LNG prices at least were slightly lower in Q3 compared to Q2, by about, I think, $8 to $10. So to that extent, the margin hit is actually not as drastic as one would expect. And in fact, the impact is actually mixed. If you look at IGL and MGL, for example, the QOQ decline is more in terms of mid-single digits. Whereas for Gujarat Gas, of course, it's the volume hit, particularly from the slightly low volumes at Morbi, that translates into a more than 29% QOQ decline in their overall profitability. YOY numbers still appear better because the base was, fairly weak in terms of, the same quarter last year. So to that extent, YOY, you actually still end up with fairly significant growth, particularly for IGL and even MGL, because volumes have continued to actually remain resilient. And I think that is a big story, in the sense that despite all the kind of price increases they've done and the relative competitiveness narrowing to petrol and diesel, volume growth still continues to be fairly resilient for IGL in particular, and MGL to a lesser extent. Gujarat Gas, as I said, the industrial volumes are struggling to compete with propane right now. So that is a bit of a worry in the near to medium term.
Okay, all right. Hi, Prabal. I wanted to ask you about these OMCs. We are celebrating that crude oil prices have come off from the peak. Now, if that's the case, stock specific, there are various other sectors, but OMCs could be beneficiaries as well, because their marketing margins are under pressure. Will they suddenly turn positive? Valuation-wise as well, it has some cushion. So the thesis is that crude oil prices is going to cool off. Will you be positive on these OMCs?
I think there are two parts to that equation. One is crude prices cooling off because of supply maybe becoming more affordable, or crude prices cooling off because demand for petroleum products itself goes for a toss. And I think depending on what answer you get a different thesis, because today what is happening is, because crude prices and therefore product prices have come off, your marketing margins for both petrol and diesel have actually expanded quite a bit. Our estimate is that petrol probably made a positive margin of as much as 10 rupees a litre in Q3, and even in Q4 that run rate continues, whereas diesel losses, which were as high as 10 rupees in Q2, also narrowed to somewhere around 6 rupees for Q3. And if we look at the latter half of the quarter, I think they were as low as maybe 1.5 to 2 rupees. So to that extent, the marketing segment obviously benefits quite a bit. However, if you look at the overall earnings, what also needs to be sustained is that GRMs do not collapse because of this decline in crude and product prices. Till now, what has happened is absolute prices have collapsed, but diesel and ATF spreads have continued to remain fairly robust. So you have a sort of an ideal scenario, let's say for someone like an IOCL, because you've got resilient GRMs, which are at least being maintained at a certain level, while marketing losses are basically going away. So that will be a monitorable to really see. My sense is that if you have to look at this space, you look at the companies which have a fairly balanced refining to marketing portfolio, which is why we've always been talking about IOCL as a preferred pick, because they have a favorable refining to marketing mix, and therefore losses in one segment can be offset by gains in the other, depending on which way the pricing and margins move.
Got it. All right. IOCL is your preferred pick. Let's talk a little bit about gas utilities, because over there it's been a double whammy for them. On one hand, gas demand has been on the weaker side. On the other hand, there's a supply shortage as well. There's higher pricing that could impact earnings. So for the likes of GAIL, Petronet LNG, GSPL, do you expect a big cut in earnings, and what would you do with these names?
I think within the gas utility space, while from a valuation front, all three appear to be very, very comfortable. They are fairly robust and solid businesses, and we remain bullish on the space from a long-term perspective. However, for the next 12 months, GAIL, I think, seems to be hurting on both fronts, because what has happened is, despite the favorable price differential between US cargoes and Asian spot LNG prices, I don't think that their trading business will be able to take advantage of it, because right now the priority seems to be backfilling all the 8 to 9 MMSCMD volume that has been lost from Gazprom. And therefore, you don't really have volumes to play with in terms of leveraging this. So from a trading EBITDA perspective, which is what had been driving profitability till a quarter ago, I think that remains under pressure. Plus, because of lower gas volumes, petrochemical and utilization has also sort of taken a hit. So in the short term, I think in the next 9 to 12 months, that will remain under pressure. For Petronet, I think earnings perhaps have bottomed out. I think utilization can only go up from here steadily, given the fact that LNG prices have not really spiked in the winter as was being expected because of favorable weather in Europe, as well as a slower rate of demand pressure from China. So to that extent, utilization may go up a little bit. GSPL, I would think that is a good play, because for a long time the stock has suffered because of concerns around tariffs being cut substantially, given that they had a lower tax rate as well as higher volumes hanging over their head in terms of regulations. Now with the change in regulations, our census tariffs will be cut only negligibly, even from FY24, and volumes I don't think will decline much from here. So to that extent, I think GSPL would probably stand out for the next 12 months in that space.
Okay, it was a very exhaustive list of stocks in the oil and gas space. Thanks a lot for prepping us for the earnings this time. Have a great one. Well, that's the word coming in on oil and gas, but don't lose sight of the market. It's a steep cut that we're seeing right now. The Nifty is down 75 points and the Sensex down 300 points. HCL Tech is your biggest loser. We should perhaps draw our attention back to the management commentary a while back, where they said that Q4 in any case is a seasonally weak quarter for them, and the higher furloughs that they saw in Q3, especially in the Asia Pacific region, could spill over into Q4. So they are expecting some caution over there. And there are no deal cancellations just yet, but Europe is one geography which is really getting challenged. So HCL Tech is a big mover on the downside. Let's take a quick break. In fact, we will we'll pose these questions to our technical guest, Mitesh Thakkar. He'll join in for a view in just minutes from now. Stay tuned.
Okay, welcome back. 60 points lower on the Nifty is what we have, 17,800. So yesterday's low, which kind of broke through the December lows, still holds. I mean, we've not gone through that. Actually, we've not even gone through, say, 17,774, but we've come very close to it, and it looks very, very tentative and not exactly inspiring price action at all. The low is 17,776 today, so just there, and then there's a bit of a bounce. Mitesh is with us. He's been saying that it's not looking good, and it is not. Mitesh, any fresh view on the index and what trades?
Prashant, on the index, my belief is that 17,800, I think, once we get closing below that, 20-point closing below that on an hourly basis, I think we could again restart a declining movement, and finally that will be a breach. That could lead to downsides to about levels of 17,730. That's one historical pivot, but maybe to about 17,500, 550 zone. So in that sense, the texture of the market isn't convincing to go on the to trade on the upside, and remains slightly on the weaker kind of a basis.
Okay, in fact,
on the stock side,
please go ahead.
Yeah, on the stock side, I think SBI Life is of interest to me. It's got historical highs around this 1330 mark. That was way back in September. So you can buy 50% now with a stop at about 1300, and once it crosses 1331, 1332, add on to your long positions, and then look for a target of around 1400 on the upside. And on the other side, I have a slightly negative bias on a couple of pharma names. Cipla is seeing breakdown after a pullback yesterday, so that's a sell with a stop at about 1070 for targets of 1030.
Okay, as you said, Mitesh, this Nifty is now heading towards that December low, right? 17,774 was touted to be a crucial support for the market and looks like it could break any time now, the December low. So do keep that on your radar. Mitesh, thanks a lot for joining in. Let's get a quick grip on what's happening in the world of commodities. Manisha Gupta is here. Manisha, what's the one commodity you're looking at this morning?
So now I'm looking at metals, and industrial metals have continued to run up and precious metals have run up too. And within that, gold is where you should keep an eye on. Fourth straight week of gains coming in for this one. And we are inching towards that $1,900 per ounce mark for the international gold prices. It's an 8-month highs. And I said, fourth weekly gain constantly coming in for the gold prices. You know, it was in the month of September that we saw gold prices decline all the way to $1,600 per ounce. But we're trading at $1,900 per ounce. And much of that strength really comes in from the decline in US dollar index, which is trading at a 7-month lows, and the treasury yields have continued to decline as well. It clearly has been $300 of a gain in last 3 months coming in for the market, and the latest trigger has been the US inflation, where the number has slowed to the lowest since May 2020, and the first time that the headline inflation also has declined to that monthly lows. So clearly a lot of support coming in because of that. And then you have CME Fed Watch tool pricing a 95% chance of a 25 basis point rate hike from the US Fed in the month of Feb, which is going to be the first Fed meeting, and markets are clearly pricing that in. That is something that has been factored in by the markets therein. Good amount of buying from the central banks. The inflation has come off but continues to stay at the elevated levels, and that is the reason you have the central bank buying coming in. In 2022, central banks bought a total of 673 tons, highest since 1967, and China as well has released its holdings at around 2010 tons. This is coming after a couple of years as well. So good amount of buying from central banks, and China and Russia are the major central bank buyers who have seen a lot amount of gold coming in. And then if you look at the funds, the managers, money managers, etc., they have been buying gold on a longer basis as well. China continues to rule that roost, 100 tons since December 20th, and 16,000 new longs have been acquired in last 1 month itself when it comes to gold there. This is what gold has done in sense of import into India as well. And we seem to be around that 700 to 900 tons of an annual import in case of gold. Last year clearly was a bumper year. You saw 1,085 tons coming in, and this was the highest in a decade that we saw into that market. Another important feature when it comes to gold is that if you look at the average return of last average return of 20% is what gold has given you in last 7 global recessions. So if the markets are looking at a slowdown or weaker number continuing, then gold perhaps is the place to go to. It clearly has outperformed all asset classes in 2023 in the first couple of weeks here. This is what most banks and brokerages are telling us. This is a conservative view. 1,700 to 1,900 is expectation of gold prices in 2023 coming in from TD, Commerce Bank, State Street Wealth and Metal Focus as well. But there are many banks and brokerage who now believe that $2,000 per ounce is coming in case of gold. Citi, IIFL and UBS are still talking about 1,900 to 1,950. Nirmal Bang talks about 2,000. Saxo Bank says that if 2,000 is taken, that 2,075 is where we are headed in that sense. Stan Charts, Swiss Asia Capital, Credit Suisse, or Gold Mining ETF all expect newer all-time highs in case of gold. They're looking at levels of 2,070, which has been an all-time high until now, to almost 2,500 is the view coming in from Swiss Asia. Stancy also says 2,250 is a possibility. Late last night, we saw reports coming in from Credit Suisse and also Goldman Sachs, who also are talking about higher gold prices. CPM says all-time highs are expected over next 5 years in case of gold. We have Credit Suisse talking about 2,200 in sense of gold as well. Swiss Asia said all-time highs in this year and the next year are a possibility in case of gold. So everywhere that you look, it's all-time highs being talked about gold.
All right, Manisha, thank you very much for that. You know, from a stocks perspective, there's no real, gold mining play. I think there was maybe 1 or 2 many years ago. But the closest we have is these gold finance companies, Muthoot, Manappuram, etc. And they've had a terrible run and no better. I mean, Muthoot especially, it's an absolute disappointment. Of course, there's a gold price aspect to it. There's all of the competition which has taken a fair bit of Muthoot and Manappuram's profitability as well. Now, let's go back to the IT stocks, Infosys and HCL Tech. The more dramatic price action, of course, is HCL Tech today. Rima is back with us to run us through what the feedback is from markets, from analysts. Rima.
Thanks so much for that. So I'm here to tell why, despite reporting a beat in numbers, both HCL Tech and Infosys, why are the IT stocks under pressure? And I'm going to give you 5 reasons. For one, the beat in Q3 was attributed to one-offs or seasonality. Now, Infosys revenues benefited by more than 100 basis points due to the pass-through of third-party items, while HCL Technologies' 5% top-line growth was boosted by a 30% jump in their products business, for which Q3 is seasonally a strong quarter. So in Q4, this products business growth rate will moderate. So the Q3 top line beat was attributed to one-off/seasonality. Point number two, the implied Q4 guidance is muted. Now remember, Infosys upped the full year revenue guidance, but despite that, according to Kotak, the Q4 revenue growth, which is implied, is actually at -1 to +0.5% growth. For HCL Tech as well, despite a strong Q3 beat, the company has not gone ahead and upped the guidance, which basically tells you that Q4 is going to moderate. Third point, there are sectoral headwinds. Now, Infosys still, prior to the earnings, had called out headwinds in a couple of verticals. They had spoken about mortgage, retail, telecom, and high tech. This quarter, they also added investment banking to the areas which are a bit headwinded. HCL Tech, you heard the management, and they told us that for the financial sector space in the APAC region, the furloughs could extend in Q4 as well. And they also said that Europe is a bit challenging. Point number 4, there are no changes in the EPS estimates for both Infi or HCL Tech despite the Q3 beat. And finally, there is still no visibility on what next year's growth is going to look like, what the tech budgets are going to look like. So those are 5 reasons why, despite a strong showing, a beat on reported numbers, both Infi and HCL Tech are under pressure today. Back to you.
Okay, Rima, thanks a lot for that. Very helpful to understand the nuances of what's happening in the tech sector. Let's slip into a quick break. On the other side, our special segment, it's the economy. Lata will be with us. She has Kaushik Das, the chief economist at Deutsche Bank, and Robert Sokin, the global economist at Citi, to discuss in detail about the US and India inflation numbers and their implications on the rate hike by the Fed and the RBI, respectively. Stay tuned.